Attention Black pre-retirees or retirees searching for annuities, information about annuities, or if you're in an annuity, you want to know if you're in the best annuity. This presentation is for you. It is titled The 7 Things You Need to Know About Annuity. So before you buy an annuity, make sure you watch this presentation. Now, again, if you already have an annuity, this is going to really help you understand what you have. A lot of times, as Black people, we do not know what we have. We don't know what questions to ask. So what I want to do in this short presentation, I'm going to try to make it as short as possible. So I'm going to answer a lot of the frequently asked questions that come up when people are searching for annuity. So let's dive in to what we're going to be covering today. The very first thing I'm going to answer is what is an annuity. Then we're going to talk about how money in an annuity is protected. We're going to talk about the different types of annuities, and we're going to discuss the 3 ways annuities grow, the fees, charges, limitations, and how an annuity might fit into your financial plan. And then we're going to kind of wrap up with the income tax question. How might an annuity impact your current or future income tax situation? And we're going to give you some real world examples so you can kind of see visually with real numbers how annuities work, how annuities protect your money, how annuities grow your money. Okay, so let's go ahead and dive in. If you've watched any of my videos, you know I like to keep things very simple. What is an annuity? An annuity is a type of life insurance policy which pays a guaranteed income. That's it. So think of an annuity as insurance for your money, insurance for your income, right? We buy insurance for various things for which we want to mitigate risk for. Life insurance for your life, health insurance for your health, auto insurance for your vehicle, right? An annuity is insurance for your money. Okay, more specifically, it is a life insurance policy which pays a guaranteed income. Now, as I said to you all, we're going to talk about the ways that your money can grow within an annuity. So not only do we have the guarantee on the income, we also have growth opportunities depending on, number one, the annuity type that we choose and how we structure that annuity. And that's what we're going to talk about in the next couple of slides. Okay, so now we know an annuity is what? Life insurance. It's a life insurance policy. Okay, it is insurance for your money. Okay, now how can you be confident that the money you place in an annuity is safe, right? If we say an annuity is insurance for your money, well, how do you know that the money that you put in the annuity contract is actually safe, right? We know that when you put money in a bank account, savings account, checking account, that you have what? FDIC insurance. Well, does something like FDIC insurance exist for an annuity? Well, actually, it does. Okay. The one way that annuities can guarantee your money is because life insurance companies have to pay into what's called a state guarantee association. In every state where they have policies, every policyholder's contract is insured up to $250,000. Think of it as the state version of the FDIC. Okay, FDIC is federal, right? The State Guarantee Association is at the state level. So you have insurance on any money that you invest into a annuity contract up to $250,000 per contract. That's per contract. So you can have multiple contracts with different companies, and each of those companies you'll have a guarantee on your money up to $250,000. Okay. Now, second bullet point, we're going to talk about a statutory accounting standards. This has to do with how life insurance companies manage their liabilities. Okay. In order for a life insurance company to conduct business in a state, they are required to have liquid reserves equal to 100% of all outstanding policies, meaning they cannot write or issue a contract in a specific state without having enough cash money in the bank to cover all of those liabilities that they have outstanding. So think of the statutory accounting standards as the state's way of governing, supervising how the life insurance companies manage their money. In order for a life insurance company to conduct business in a state, they have to adhere to statutory accounting standards, which require that they have at least 100% all liabilities in liquid cash reserves. Third thing, life insurance companies are assigned an independent rating. There are 3 ratings agencies that rate life insurance companies. Life insurance companies can receive anything from an A rating all the way to an F rating. Okay. Moody's, S&P, and AM Best are the ratings agencies which assign a rating to the insurance company based on the overall stability of the life insurance company's financial portfolio. Okay. They look at the composition of the portfolio, how much money they have, a few other things they look at. But this is a third-party agency that comes in independent of the State Guarantee Association, independent of the state or the statutory accounting standards. There's a third-party agency which assigns a rating. Now, with the ratings that you have assigned, or you see assigned, larger companies are going to tend to have higher ratings than smaller companies, right? So you might see a B-rated life insurance company, and you might say, well, the A company is better than the B company, and that's a pretty intuitive way of thinking about it. But in all actuality, the B insurance company might be a B company just because they're smaller, okay? So I always recommend A, B companies. Don't go any lower than a B company. A, B companies are good in terms of being able to having exhibited a standard of financial management with respect to their liabilities that the independent ratings agencies feel would warrant that company having an A rating, B rating, etc. All right. And then here's another one. I get this question a lot, and the question is, well, how do life insurance companies make money? Well, they make money by taking all of the money that they get, annuity premiums, life insurance premiums, and they invest that money in investment grade fixed income securities. About at least 90% of a life insurance company's investment portfolio is comprised of investment grade fixed income securities. So think about savings bonds, treasury bills, T-notes that are issued by the federal government. So they're taking the majority of their capital and they're buying U.S. treasuries. And those treasuries earn a predictable rate of interest. And the way you earn interest is by them paying you a percentage of that interest that they're earning off of that portfolio. The stability of that portfolio is also what contributes to the stability of the annuity, because the annuity, by and large, is earning money based on what? The life insurance company's investment portfolio. They take your money and they invest it, they make interest, they pay you. Okay, so the way that they're able to provide the guarantee is they're basically taking your money and they're buying U.S. treasuries from the federal government. Okay, so these are the 4 bullet points that you want to remember when asking, how is my money safe? Your money's safe because of the State Guarantee Association statutory accounting standards. You know more based on independent ratings, and obviously the investment portfolio composition of most life insurance companies is based on, again, in most cases, 90% or more investment grade fixed income securities. Now, what are the different types of annuities? Okay, now there are 2 types of annuities. Okay, you have what's called an immediate annuity and a deferred annuity. Now, let's pause for a second. You all remember how we started this discussion. What did we start with? We said what? An annuity is nothing but what? Insurance for your money. More specifically, it is insurance for your current or future income. That's what an annuity is. However, you get to choose when you receive an income off of your annuity. You can choose to receive an income from your annuity immediately, okay, which is the top one. Now let's start with what an immediate annuity is. An immediate annuity is an annuity where you make a deposit with the life insurance company and they begin to pay you an income stream right away from that deposit. Okay, those of you who are real estate investors, you buy rental property, right? You buy rental property because of what? The passive income. So think of the immediate annuity as a life insurance policy that pays you passive income immediately. Okay, you make the deposit, within a month, the life insurance company starts sending you a paycheck. The other piece to that is because it is insurance for your money, the money never stops as long as you live. So you will receive these red rectangles as long as you live, even if the account goes to zero. So if you put $100,000 in an immediate annuity and they pay you $5,000 or $10,000 a year, they're going to pay that to you even if you deplete the $100,000 deposit. Because why? It is insurance for your money. That's one of the benefits to having an annuity. You never have to worry about running out of money before you run out of time. Now, that's the immediate annuity. At the bottom, we have what's called the deferred annuity. Now, I should have did this at first. The blue shaded rectangle represents the premium or the deposit that you pay into the annuity contract. So in the deferred annuity example, you make a deposit, but you choose not to receive your income immediately. You choose to receive your income at some point in the future. You say, well, Jared, why would I do that? Well, of course, think about it. If you wait to receive your income, guess what? In the future, your income is going to be more than it would have been had you taken it right away. So that leads to the second point. The deferred annuity has a higher income stream in the future than the immediate annuity will have. If you did the immediate annuity, you might only receive a certain amount, might be $3,000 a year. Whereas if you defer it for 5 or 10 years, think about with Social Security, right? Everything comes back to what? Deferred gratification. With your annuity contract, if you are looking for growth, if you're not needing the money right now, then you're going to be looking at the deferred annuity. And that's going to be what most of you who are searching for annuities, that's what you're going to want to look at, because that's going to give you the growth and the income that is much more than you would receive doing the immediate annuity. So again, 2 types of annuities: immediate annuity, deferred annuity. For most of you, you want to look at the deferred annuity. All right. Now, we know about the 2 types of annuities. What are the ways that the money in the annuity grow? Like, how does the money grow within the annuity contract itself? Okay. Well, it depends on the type of contract that you choose. Okay. Now, there are three types of contracts that you can choose. You have what's called a fixed contract, which is the first one here, an index contract, which is the second one, and the third one is what's called a variable contract. Now, I'm going to show you an example of each of these. Okay. Now, let's look at first the fixed annuity. Okay, let's start with the fixed annuity. Then we'll go to the index. Then I'm going to talk to you briefly about the variable. The fixed annuity pays a fixed rate of interest. Okay, so let's look at how that looks. Okay, on the screen, I have an example of a $10,000 fixed annuity. So you put $10,000 in the fixed annuity contract. And let's say you're doing the deferred annuity. So in other words, you are making the deposit and you are allowing the interest to grow during the deferral period so that you can have a higher income, more growth at a later time. Look at what we see with the rate for the fixed annuity. With the fixed annuity, you see that the interest rate that you're going to earn on that contract is fixed in every single year. You know exactly what your interest payment is going to be every single year you have that contract. There are no surprises. Okay? You know exactly what you're going to earn. These are known as MIGA contracts, or multi-year guaranteed annuity contracts. Now, if you all have your thinking caps on, you're probably thinking, that sounds a lot like a CD. Well, guess what? That is exactly how you want to think about a fixed annuity. In fact, a fixed annuity is a great alternative to a CD. And the reason why is because you're going to have the same safety in a fixed annuity as you do in a CD. The difference, however, is in the fact that the fixed annuity typically pays you interest that is significantly more than what you would make in a CD. And on the screen here, we have the showing you the interest rate differential between fixed annuities and certificates of deposit through June of 2022. And you can see that the difference between the average annuity and the average fixed annuity and an average CD is about 5 times. So a fixed annuity is a fantastic way for you to have a higher interest rate than you get in the CD, okay? And also have that rate locked in for a longer period of time. Now, this is okay, but it's not the best alternative or the best choice. That is the fixed annuity. It's not the best choice if you're someone who is looking to maximize your growth opportunity. So what other ways can we earn interest? Okay, so again, you buy a fixed annuity, a fixed deferred annuity, they're going to say your interest rate is 5%. You're going to get 5, 5, 5, 5, 5. So you sign a 5-year contract, you're going to be locked in to receive a 5% interest rate every year. Now, that's the fixed annuity. Then we have what's called an indexed annuity. Some you may actually probably have seen them called fixed indexed annuities. But an indexed annuity earns interest based on an underlying index. Now, to really illustrate how fixed indexed annuities work, I have on the screen a red line showing you how the stock market performed over a 12-year period between 1998 and 2010. Now, here is where the fixed index annuity gets to be interesting. The fixed indexed annuity gives you the ability to earn money alongside the stock market, say for example the S&P 500. You make money when the market increases, okay? But if the market decreases, you don't lose anything. Fixed index annuities have what's called an annual reset option. They also have what's called a zero floor. A zero floor means that when the market declines like it did in 2001 to 2002, or what it did in 2007 to 2008, or like it did during the pandemic, the start of the pandemic, stock market fell. If you had money in the stock market, you would have rode that roller coaster. The ups you would have got, the downs you would have got. Okay? Now, we know that the fixed index annuity gives us a zero floor, so we don't lose anything when the market goes down. But we also make money when the market increases, and we never lose any of the gains that we make. So let's see how the fixed index annuity works. Again, you get the upside potential, but the downside protection. So what I'm going to do now is overlay the indexed annuity line on top of the stock market line. And if you can notice something here right away, that from 1998 to 2000, that 2-year period, both the indexed annuity increased and the stock market increased. But you notice the steepness or the slope of the stock market line is much steeper than that of the fixed indexed annuity. And that is because with fixed index annuities, you don't get 100% of the upside. Okay? You might get 80% of it, you might get 90% of it, but you're not going to get 100% of the good years. You're going to get most of them, but you're not going to get all of them. But the trade-off to that is that when you have something like 2000 to 2002, when the market fell in 1 year, then it fell again in the second year, notice how your fixed index annuity line is flat. Okay? So in other words, you don't make anything and you don't lose anything. You just stay at zero. And I always say zero is your hero when everybody else is losing money. Think about it this way, those of you who are sports fans. Okay? If you're playing basketball, football, right? You don't always have to have a strong offense to win the game. A lot of times defense wins the game, meaning not losing. Okay? Protecting the home base can actually win the game for you more than making every shot. And that's how you want to think about as a black retiree or pre-retiree that's looking at maybe looking at the news, a lot of things happening with banks and stuff. A lot of things that were surefire are not so surefire anymore. So what you see here is with the indexed annuity, we have the ability to participate in the stock market without having our money directly at risk within the stock market. Okay? Again, you don't get all of the upside, you get most of it, but you get none of the downside. And you can see how that would have played out between 1998 and 2010. You would have had more money in your indexed annuity than you would have had in your stock market account that was 100% invested in the S&P 500. Okay, so again, this is a visualization of how indexed annuities work. Okay, now let's talk about variable annuities. Now, I don't have much to say about variable annuities other than the fact that a variable annuity is a life insurance policy contract that invests all of the money that you put into that annuity into the stock market. Variable annuities can be anywhere, you can be charged anywhere from 2 to 3%. They're expensive and they're at risk within the market. So for that reason, I don't recommend variable annuities, because why would you own stock in your annuity? You can own stock in your 401k IRA. You keep them separate because it'll be cheaper to do it that way versus having the annuity fees on top of the account management fees that you're going to have to pay with a variable annuity. So variable annuities, again, are not going to be something I'm going to recommend for purposes of today. We're going to stay focused on the indexed annuities because they give us the best of both worlds. We get the gains, but we don't have the risk that we would have with a variable annuity or with a mutual fund, individual stock, ETF, etc. Okay? Now, let's talk about the fees, charges, and limitations of annuities. Now, this will apply to all annuities, the fixed annuity, the indexed annuity, and the variable annuity. Okay? Now, here are some of the fees and charges that you want to think about. First thing is first bullet point, all annuities have what's called surrender charges. Okay, that is like similar to a CD. When you buy a CD, right, you have to keep that money in the CD for whatever the contract is. If it's a 5-year CD, you have to keep it for 5 years. If it's an 18-month CD, you got to keep it for 18 months, right? If you take money out of that CD within that contract period, before the contract period ends, you get charged a penalty. That is exactly how your annuities are going to work. You're going to have withdrawal fees if you surrender that contract before the contract expires. Now, that leads to the second bullet point. Most annuities have contract terms between 5 and 15 years. 15 years is on the high end, 5 is on the low end. Most of the time, it's going to be around 10 years. Okay, so if you are considering an annuity, it is going to be a long-term commitment. It is not going to be something where you just do it this year and then, oh, I changed my mind next year, I want to get out. You can get out of it. You're just going to pay the surrender charge. Okay, so again, but in most cases, that's not a big deal, right? Because you're 60, you don't need the money right now anyway. If you're 60 and you're working and you don't have enough saved, why does it matter that it's a 10-year surrender period? You can't retire right now anyway. So why not again take advantage of the deferral? Remember, the deferral is going to be the best option to give you the highest income and the highest growth. Take advantage of that deferral so that at the end of that 5 or 10 or 15 years, you have more income and more value than you would have had you, for example, did an immediate annuity or not done the contract at all, depending on what your individual situation is. The third bullet point is some annuities can actually be set up to where they do not charge you any fees. So you can actually purchase an annuity that does not charge you any annual fees. Okay, so the annuity contract in terms of the fees can be a free contract, but remember, this is always like anything else in life. There's always a give and take. So if you get a fee-free annuity that doesn't charge you like a fee, okay, those annuities are typically going to earn less interest than the ones that charge you a fee. So when you are shopping for an annuity, don't just look at it as, oh, I'm not paying anything, because if you do the analysis, you might end up better paying the whatever it is, 1% fee or 0.5% fee to get a much higher interest potential versus going the free route and having a balance or an income that's significantly lower than it could have been had you just went ahead and paid the fee. And typically, these fees can, they could be 0.5%, they could be 1%, but they're not going to be anywhere near what you would pay if you had a variable annuity. Okay. Also, as I mentioned already about the variable annuities, the fees for variable annuities can be up to 3% a year. That's on the high end. As I said before, we're going to focus our discussions on the indexed annuities because those are going to be the ones that give us the growth potential without the risk. The variable annuity also doesn't have any guarantees on the account value. They have maybe a minimum guarantee, but again, you can potentially lose most of or all of the money that you put into that account. So just Again, if you're considering a variable annuity, this is not the presentation for you. But I do want to make sure, in case some of you are looking at variable annuities, that you are aware that variable annuities do charge a lot of fees, and there's not as many guarantees on that policy as you would have, say, with a fixed annuity or with an indexed annuity. Okay. And this goes back to the fifth bullet point, goes into what I said initially when I said on the last slide, which is annuities do not, if you choose the indexed annuities have caps, participation rates, and or rider fees. So what that basically means is you're not going to get all of the upside. So if you were to say have $100,000 and the market is doing really well, right? Most years the market does okay, right? Well, if you're 100% invested in the stock market, when the S&P or the Nasdaq or the Dow or whatever goes up, when those indices increase, you're going to see all of that increase. So if you're well diversified amongst the S&P 500, right? And the S&P 500 goes up 20%, then you're going to earn 20%. Okay? But if you have that money in an indexed annuity is usually going to have a cap on how much you can make. It might have a 10% cap or 12% cap, whatever. So what that means is that if the market goes up to that number, you'd only get that number. You won't get anything above that. So going back again to the example with the S&P, the S&P goes up 20% and you're in a index annuity that has a 10% cap, you're just going to get the 10%. You're not going to get the 20%. That's what a cap does. A participation rate, it does a similar thing as the cap, where it basically says you only get a percentage. It could be 50%, could be 60%. So going back again, S&P increases 20%. Okay, you have a participation rate of 80%, then you'd only get 80% of 20%, or 16%. Okay, I usually with my clients, I always go for the participation rates, just depending on the setup, because participation rates don't have a cap. So if the market goes up 30% or 20%, you end up making more than you would have made had you had a cap on you. Okay, the rider fees might be on annuities that basically don't have a cap or participation rate, but they might charge you a spread where they take a certain percentage out of what's earned on that increase. Okay, so again, main thing here, depending on the company you choose, the indexed annuity will have a cap, participation rate, and or rider fees. Again, you can choose a number of different options there, cap rate, participation rate, or you could do a combination of these. Again, the main thing is having that downside protection, upside potential, and obviously having that income guarantee later on when you're going to need that income. Okay. Also, a thing that's unique to annuities that you won't see with the CDs, this is for those of you who might be considering a fixed annuity, which is again called a MIGA, multi-year guaranteed annuity. Well, if you're looking at a CD, you got some money to put aside into a CD. Remember, we talked about CDs having, you have a penalty if you cash in the CD early, right? Well, we talked about annuities having contract terms of 5 to 15 years. So if you cancel, you cash in your annuity before that contract expires, then you're going to pay a surrender charge. Now, another thing I forgot to mention this, the surrender charges that you pay in an annuity are on a sliding scale. Okay, so when you first buy an annuity, that surrender charge might be 10%, but it's going to decrease every year that you own that annuity. Okay, also, the annuities in most cases will offer you what's called a penalty-free withdrawal after the first year, usually up to 10%. So after the first year of you having that annuity contract, if you want to take 10% out every year, year 2, year 3, year 4, year 5, you can take that 10% out without a penalty, without a fee. So the penalty charge only applies if you take out more than the 10%. Okay, so again, this is great because it's actually better than a CD, because if you're considering a CD, you can do a penalty-free 10% penalty-free amount on a fixed annuity and not have to worry about any fees or charges. Whereas if you had that same money in a certificate of deposit, you would be assessed that surrender charge in all years. Okay, so these are the 6 bullet points that you want to think about: the contract terms, surrender charges, the fees. The rates that you're going to earn are going to be based on, again, if you have a cap, participation rate. All of these are things that are going to be pretty standard regardless of what annuity you choose. Okay, now this is really probably my favorite section of this presentation. How might an annuity fit into your overall financial plan? So this really goes into the question of suitability. How do you know, or how can you know if you are the best candidate for an annuity? Okay, well, to answer that question, we really first need to answer the question of, why would you purchase an annuity in the first place? Now, that goes back again to how we started this discussion, right? We said what? An annuity is insurance for your money, right? So if you are someone, so that's the first thing. If you are someone who is risk averse, you're afraid of losing money, you want to make money, but you don't want to have to worry about the bad years, then that's number one. That's checkbox number one. But let's kind of go further down that line. Now, we talked about the stock market when we looked at the indexed annuity, and I showed you how the S&P 500 performed from 1998 to 2010, and I overlaid the blue index line to show you how the fixed index annuity would perform in comparison to the S&P 500. Now, on the screen now, I have something else that you have to think about. Again, this is answering the question, how do you know if an annuity is right for you? So we know it's insurance for your money, but what does that mean? What does that mean? On the screen, I have a recovery time chart. This is what this means. We all know, I'm going to tell you this, I say this to even in my classes that I do every Saturday. You never, ever, ever make money as fast as you lose it. You always lose money and spend money faster than you make it. You always do, with the exception of the times that you might win the lottery, or you might go to the convenience store and you do a scratch off and you win $500. I'm not talking about those. Those are all exceptions. As a general rule, you never make money as fast as you lose it or spend it. Now, what am I getting at? When you're thinking about your retirement, when you're thinking about the money that you've saved in your 401k, in your TSP, you got your IRA with Fidelity, with Vanguard, with Empower, right? You got all this money. You've worked your entire life to save that money. Well, let's say you lose 20%. When you lose 20%, you have to make 25% to get back to break even. In other words, your money has to work harder to get back to break even than it did for you to lose it. If you lose 20%, you don't have to make 20, you got to make 25 to get back to break even. Remember what I said. You never make money as fast as you lose it or spend. Let's keep going. Let's say you lose 40%, which is what happened between 2001 and 2000 and 2002 when we had the September 11. Similar thing happened in 07, 08. Similar thing happened at the start of the pandemic. You lose 40% of your retirement account. Well, guess what? You got to make 66%. Do you know how hard your money has to work to make 66%? It may have taken you 3 years, 4 years to grow your retirement account by 66%, but you can lose 40% in 1 year. You never make it as fast as you lose it or spend it. So this is the point I'm trying to get at here. You don't only have to think about protecting your money, meaning not losing money. You also have to think about, how long is it going to take me to get back to where I was? Now, if you are 40 or you're 30 or you're 20, then maybe presumably you have more time, right? But if you're already in your 50s, 60s, you don't have the time. So remember, it's not just making the money back, it's how long is it going to take me to get back to where I was. And that is the thing you want to think about. Remember, an annuity is insurance for your money, right? We're protecting the income, right? The income potential. We're getting a guaranteed income. We have protection on the money we put in there. But it's also protecting your time. You don't have to worry about making it back up when you're already in your 60s or 50s and you simply do not have the time. And especially in our community, most Black retirees, pre-retirees, simply do not have enough money in the first place. So you don't have enough money in the first place. You're not in a position to deal with a bad couple of years and having to wait 2 or 3 times as long to make the money back. So that's the recovery time. The second thing, or the other thing you want to think about, is what's called sequence of returns. And that has to do with the risk of running out of money before you run out of time. Now, I'm going to sort of kind of go through this quickly because I know for a lot of you, this is the first time that anybody has broken down annuities this way. But I think that we're doing a pretty good job of simplifying these concepts for our Black retirees and pre-retirees that need direction, because a lot of times in our community, we don't know this stuff. My goal is to change that. So let's look at this other risk we want to think about. Running out of money before you run out of time. Okay? Now, here's the thing. When you think about running out of money before we run out of time, you also want to think about not only losing money or protecting your money and the time of recovery, you also want to think about when your good years happen versus when your bad years happen. Now, what do I mean by that? Let's look on the screen here. I have client A on the left and client B on the right. Now, both clients started with $1 million. See this $1 million here? Look at the starting balance column, everybody. So see this $1 million I got here? Now look over here. This person had $1 million as well. But now you're looking at this and you're like, well, now look at the bottom real quick. See at the bottom, we got this person averaged 14.89%. So that's basically taking all of these numbers from 1 all the way to year 30. If you average all these numbers, that totals what? 14.89%. That's the average. But then you look over here and you like, how is it that both of these people have the same return, right? 14.89, 14.89. But this person ran out of money in the 11th year. Whereas this individual had money, they actually end up growing their account from 1 million to 14 million in the 30-year period. How is it, Jared, that they can have the same average return, but one person grew their account 14 times, whereas the other person ran out of money in the 11th year? Pay very close attention to the red rectangle. Look at what's happening in this red rectangle, everybody. What are you noticing with these numbers? What is this number? 4, 14, 18, negative, 37, 23, negative, and you come all the way down, right? But look over here. This person had 21, 28, 33, 22, 37, 1, 10. In other words, what you should notice here is that the person on the left side had bad years early. And as a result of having back-to-back bad years, they only had 2 years of back-to-back bad earnings, right? But as a result of those 2 bad years, that basically took away the cushion that they had. So this is what I'm getting at. It is not only about how much you earn on your money, it's about when you earn it. See, this person over here, they had bad years, but they had bad years later on after they had already made their money. They had a a runway, in other words, where they built up a cushion so that whenever they did have those bad years later on down here, it didn't hurt them as bad because by then they had already built up their what? Piggy bank. So what you also want to think about is not just how long is it going to take you to recover. You have to think about when you make money and when you lose money can also determine if you run out of money before you run out of time, because you got to keep in mind you still going to be taking money out of this account. If you have money in your 401k, your IRA account, you have to do what's called required minimum distribution, which means what? You're going to have to take money out of the account regardless if you need it or not. They're going to make you take it out. So imagine being in a situation where you have to take money out of the account, but you also just had a bad 2 years in a row. So you getting hit double. You getting hit triple. You getting hit because you lost money, these red negatives. You getting hit here because you still got living expenses that you got to take out. And then you're going to get hit when you take it out because then you're going to still have to pay taxes on it. So you getting hit 3 different ways. You see, it's not just the losing money, it's the taxes, it's your living expenses, and you're still got to pull that money out of the account. So this is the thing about sequence of return and the risk of running out of money and why an annuity can be an ideal solution for you, particularly if you are starting from a position where you're not where you should be. If you're already starting from a position where you don't have a big balance, you maybe started late, or you don't have as much in that account as you should have, you can't afford to have 2 or 3 years of losing money because you may not ever catch it back up. You may not ever get back to break even. So this is where what we talk about insurance for your money. Having your money in an indexed annuity allows you to circumvent the risk of running out of money, having to worry about the recovery time, having to worry about losing money. That's what we mean. The risk of running out of money, the risk of losing money, and having to deal with the recovery time. Having the annuity gives you insurance on your money, just like you have insurance on your house, insurance on your health, insurance on your car. That's what we mean by insurance for your money. So if you're trying to determine if this resonates with you, then you want to really seriously look at allocating at least a portion of your money into some type of an annuity that gives you protection from these risks that we're referencing right now. Okay? All right? Now, let's we're going to kind of get through this rather quickly. How do annuities affect your income tax situation? So let's say you buy an annuity, right? You have money, you want to put that money into an annuity contract. You want to know, well, how is this going to impact my income taxes? How is it going to impact my current income taxes? How is it going to impact my future income taxes? When do I pay taxes? How much taxes? So let me just help you. I got 4 bullet points on the screen. First thing I want to say before we go through these bullet points is the taxes that you pay, or if you pay taxes, will depend on how you fund your annuity. Okay, there's 4 ways that you can fund an annuity. We're going to talk about those. First way is what's called qualified money. So this is basically your retirement money. So you have money in an IRA, a 401k, a 403b, a TSP. That money can be used to purchase an annuity. If you're using pre-tax retirement money to purchase an annuity, the tax implication is going to be neutral. It's not going to increase or decrease your taxes because all you're doing is moving it from one retirement account to another retirement account. So when you use retirement money to purchase an annuity, it is known as a retirement annuity. So you can actually roll over your IRA, 401k, 403b, TSP, 457 into an annuity contract without any income tax, without any current income tax implications. Now, because you are using retirement money, all of the same rules apply as apply having the money in an IRA or 401k. You're going to pay taxes when you take it out, right? Because you never paid taxes on that money. You deferred that money into that retirement savings vehicle. So when you get ready to take it out, you don't have any taxes going in, but when you take it out of the annuity, you will pay taxes as you take your distributions. But again, that's going to be the case regardless if you purchase the annuity or not. You have it, if you leave it in the 401k and don't ever take it out, guess what? When you do take it out, you're going to pay taxes. Same thing as with an annuity. So it's not going to adversely impact you one way or another. You're just going from one retirement vehicle to another retirement vehicle. Also, RMD is required. So when you get to 72, okay, when you hit 72, you're going to have to take R&B. You're going to be required to take money out of the annuity, regardless if you need it or not. I know a lot of my clients are maybe retired. Maybe they, you have a pension, you have Social Security, you have investment income, and maybe the money in your TSP or your 401k or IRA, just you don't really need the money, right? Well, guess what? It doesn't matter if you don't need it now. When you get to 72, you're going to have to take it out. Okay, so again, qualified annuities are annuities that are purchased with retirement money. No income, no current income taxes on withdrawals, RMD required. Also, you have what's called non-qualified annuities. Now, a non-qualified annuity is an annuity that you purchase with all money other than your retirement money. So this is money in your savings account, money in your checking account, money, maybe you sold a house, you got a big chunk of money, you want to put it in an annuity. All of those was considered non-qualified annuity. So an annuity purchased with any funds other than your retirement money is considered a non-qualified annuity. After-tax funds used to purchase the annuity was considered non-qualified funds, or it would be considered a non-qualified annuity. Still tax deferred, right? So you don't pay any taxes on the money while it's compounding in the contract. When you do take withdrawals from a non-qualified annuity, you're not taxed on the full amount. You're only taxed on a portion of that withdrawal because they treat the distribution as a partial return of principal. So remember, when you funded that non-qualified annuity, you funded that non-qualified annuity with after-tax dollars, meaning you already paid taxes on that. So the interest that you earn, you hadn't paid taxes on. So when you withdraw money, the IRS is going to treat that as a partial principal, partial interest withdrawal. Okay, RMDs are not required with non-qualified annuities. Okay. Roth IRA annuities. So this again, those of you who have Roth IRAs, you can use your Roth IRA. You can roll that money into an annuity contract. Okay, Roth IRAs are tax-free. So if you fund your annuity with a Roth IRA or Roth 401k, any Roth money that you're using, then the annuity will also be treated the same way it would have been treated, or the funds in the annuity would be treated the same way they would have been treated had you not ever put them in the annuity. In other words, the money that you earn on that annuity will also be tax-free as well. Okay. Also, you all remember, as long as you've had your Roth IRA for at least 5 years, then all of the growth is tax-free. So this is usually not an issue, but if you just if you just started an IRA account, for example, right, and you use that to purchase an annuity, you have to make sure you have for at least 5 years or it still won't be considered tax-free. Okay, so that, again, don't get caught up on that. The main thing is Roth IRA annuities are also tax-free when you take the money out. Then finally, this is for those of you who might have, maybe you already have an annuity, right? You already have an annuity with a different company. maybe the annuity is not growing. Maybe you might be in a fixed annuity and you're considering maybe changing into an index annuity, right? And you're like, well, should I make this change? Or if I change this, if I change companies, how would that impact me? Well, that's the very, very good question. There's something called a 1035. So what that means is that if you have a current annuity contract, you can absolutely, okay, change annuities. You can transfer that current contract to a new company without any income tax implications. Okay, so if you are in an annuity, maybe you've been in an annuity for 10 years or 8 years, maybe you're almost at the end of your contract. You want to change companies, you've earned a lot of money, you grew your money in the annuity, you want to go to a different company. You can actually do that without any income tax implications. Now, that's the income tax piece. That doesn't mean that you won't have a surrender charge. So you still want to make sure that you are at least to the end or close to the end of your contract so that you can avoid any of the surrender charges. Now, sometimes it makes sense to still go ahead and pay the surrender charge. If you're with a company, you're not earning, you might be an annuity that's only earning 3%. You maybe bought your annuity 7 years ago, 8 years ago, when interest rates were lower. Maybe you got a 2% annuity, 3% annuity. Well, interest rates have went up significantly since that time. So you have the opportunity to go out of that annuity, change from that annuity to another annuity. Well, for you, it might be worth you paying the surrender charge, because what you're going to gain by making that change will be more than enough to offset what you're going to lose in the form of the surrender charge. So those are all considerations that you want to think about when you already have an annuity. But again, the income taxes on an annuity, on annuities, is going to depend on how you fund the annuity: qualified, non-qualified, Roth IRA, or 1035. Okay. Now, here's just kind of briefly giving you some examples of how the growth potential of a fixed index annuity. Remember, I told you we're going to focus on fixed index annuities because these offer most pre-retirees and retirees the best risk reward profile, having the ability to grow your money without having the risk associated with 100% of that money being in the stock market. In this example, the individual deposited $200,000 into the annuity contract, and you can see that within 5 years, that person made $136,000. In 10 years, they made $350,000. You can see that this annuity contract has consistent growth. This is another piece to annuities. Annuities can be a very powerful generational wealth creating policy. So if you are in your 50s, in your 60s, you got a little bit of money saved, you want to protect that money. You still working, you got some time before you retire, but you want to protect that money, and you want to have that money be a part of the legacy that you're leaving for your kids and grandkids. A fixed index annuity is a very powerful generational wealth creating strategy. And in this example, had you invested $200,000 in this annuity, in 20 years, that $200,000 would have grown to $1.5 million. If you really wanted to keep going with this thing, over a 30-year period, a $200,000 investment would have grown to $7.8 million. Okay, so this is showing you how, yeah, you don't get 100% of the market upside, but hell, I don't care, because if I'm able to take 200,000 and over a 30-year period turn 200 into millions of dollars with no market risk, sign me up all day long. So this again is just showing you all the potential that exists with indexed annuities, the ability to grow your money, to protect you from the recovery time, to protect you from running out of money, to protect the future income that you can create from the guarantees within the contract. And remember, the deferred annuity is what we're going to do when we're looking for growth, because if you don't need the income right now, why take that income and take less when you can wait 5 or 10 years and take more? In this example, 55-year-old deposits $100,000 into the annuity contract. The income account value is $130,000. Another thing with deferred income contracts is you will typically receive a bonus on what you put in. So that's another piece. With these annuities, if you are, maybe you've lost a little bit of money, you can actually make a deposit into a income annuity contract, a deferred income annuity contract, and you can actually earn a bonus. They will pay you a bonus on your deposit day one. So you put 100,000 in, your income balance is 130,000. And your growth happens on what? The 130 and not the 100 that you put in. Another thing we want to think about is long-term care. We're able to build long-term care into our annuity contracts with certain insurance companies. So that does what? That maybe helps you plan for long-term care, where you don't maybe have to go out and buy a separate long-term care contract. Now, doesn't mean you shouldn't, right? More insurance is not going to help you, right? But if you are budget constrained, you maybe you have some certain health things, certain things running your family, maybe dementia, maybe diabetes or whatever, where you basically seen your mama, your auntie, your uncle, and or they get some other things happening with their health as they get older. Well, guess what? Maybe 5, 6, 700,000, $1,000,000 is not so much when you got a lot of stuff going on with your health. Well, what this income annuity can do is it gives us the ability to have more income paid out to us if we have a long-term care issue. Doubling the income. You at 12,000, now you're getting 24. You at 25,000, now you're getting what? 50,000. And look in the income account column. Notice how even when the account goes to zero, look to the left of that. You're still getting $23,000 that year. This is what we're talking about. Having income protection. Now, this is going to be a very powerful planning tool for many of you who are concerned about Social Security. In fact, some of you don't get Social Security. Or if you do get, if you're going to get it, you probably won't get that much, right? Some teachers don't get Social Security because guess what? The school system that you work in doesn't pay into Social Security. So the only form of retirement that you're going to have is the pension that you get. Well, 9 times out of 10, that's not going to be enough. So guess what you can do? Take that 403B, put it in a deferred income annuity contract, get that growth. So now when you hit 65 or 62, you have another guaranteed source of income that's independent of Social Security. This is what we're talking about. Going back again, an annuity is insurance for your money, insurance for your income, insurance for your principal, insurance from the recovery time, insurance from running out of money. That is what an annuity contract can do for you. Okay. Now, let's combine this. Okay, let's combine all these together. This is the last slide. I want to show you all how these can work. So let's say you do a deferred annuity. You put $500,000 in that annuity. You defer that annuity because you're going to let that money grow. In the black circle, you see that $500,000 grew to what? $800,000 in 5 years. And if we decide to take an income off of that $800,000, we get to receive $36,000 for the rest of our life. And catch this, the several insurance companies have inflation protection. So the $36,000 that you see at the bottom is just your first year payment. You're going to receive increases in that income. Next year, maybe the year after that, the year after that, maybe the year after that, the year after that. So by the time you get to 10 years out, your income could be double. Your income could be $72,000 because you're going to get increases along the way. That can be built in to your contract. See, these are the types of things that Black retirees and pre-retirees have to take advantage of. This is the kind of stuff that we as a community need to be taken advantage of. We need to take advantage of these insurance policies and what they can actually do for us. And this is a prime example of what a insurance policy can do for you. What is an annuity? An annuity is a life insurance policy. It is insurance for your money, insurance for your deposit, insurance for your income, insurance against stock market risk, insurance against having to wait on your money to come back when you already don't have enough in the first place. This is what an annuity can do for you as a pre-retiree or retiree. All right. Everybody, I am done for today. I'd like to thank you for listening to me, everybody. This has been fun. I told you all, make sure you like this video, because when you like the video, the algorithm, the YouTube algorithm, will know who to show this to. Secondly, make sure you subscribe to my YouTube channel. Check out my YouTube channel. I'm launching a podcast. I'm also going to be putting out a ton of content on different topics: real estate investing, income taxes, entrepreneurship, estate planning, a ton of things we're going to be talking about. The goal is to help build Black wealth. Black wealth matters. Black lives matter. Black wealth matters too. Okay? So I invite you all to register. So there's two things. First thing is, you can register to attend one of my free workshops. Now, to the side of this video, there's going to be a button, maybe to the bottom, to the right. You can click on that button. That is a registration tab that will take you to the life insurance workshop. Now, this particular presentation today was about annuities. I'm going to go a lot deeper. I'm going to talk to you about the different types of insurance, how you can structure insurance policy to create tax-free income. We're going to talk about all of the things that you can do and all of the different types of insurance policies. Again, as Black people in this country, we have to make sure that we get this information and apply this information. And in most cases, we don't know this information. So what I'm doing in this workshop is I'm giving you a ton of free nuggets that's going to help you build wealth with life insurance. Okay. Today we talked about annuities, but in that workshop, I'm going to go a lot deeper. Okay. So please make sure you register for that workshop. Now, if you are watching this, you're like, oh, I don't have time to go to the workshop. Well, guess what? You can request a free consultation. There'll be a button, at the bottom of this video. If you go to my YouTube page on right under this video, there's going to be a button. All you got to do is click that button and request a consultation. You can get on my calendar and we can talk through your individual situation. If you're in the market for an annuity, you went through this, so you've been educated on what an annuity is, what an annuity can do, all of the different fees and limitations. You got all of that stuff. But if you want to have an individual consultation with me, you can click the button below this video on my YouTube page, and it's going to pull up my calendar. You're going to answer a few questions, and it's going to put you on my calendar, and we can talk through your individual situation. Okay? I'd like to thank you all so very, very much for attending today's presentation. This is your host, Jerry Gordon, President and CEO of the Black Wealth Company, where we build Black wealth. Thank you all for watching. I will see you on the inside. Again, click to register for the workshop. You want to go deeper down the rabbit hole, the blue pill or the red pill, blue pill, red pill, or purple pill. Maybe you want to do the purple pill. If you want to do the purple pill, just do a consultation. Then we can talk. And if you want to learn more, you can still attend the workshop. I love you all. Thank you so much for joining. Peace and blessings to you all. Bye for now.